Hello, we are here with Joseph Wang, or Fed Guy. Everyone knows him as the guy who ran QE at the Fed's trading desk. But Joseph, we would like to know, what was your backstory before you went to the Fed?
Hey guys, first of all, thanks for inviting me. Glad to see you two again. So I actually have a pretty atypical backstory. I actually started my career as a lawyer. So I went to college, I studied econ and math, and then somehow I decided that it would be really good to be a lawyer. I think back then I was looking just for a job that, would earn a lot of money and, sound fancy. So I went to law school and then I practiced for a little bit. And then I realized what I should have realized a long time ago. It's that being a lawyer is really awful. So, sure, you guys go to school. If you write a report, like a term paper or something like that. So being a lawyer is basically writing term papers for the rest of your life. And that's just not fun. So you're kind of like almost an expensive secretary sometimes. But so back then it was just at the beginning of the GFC. And I began to realize that, something much more interesting than law would be markets. Because if you were following what's happening back then everything that people could talk about was what was happening with the markets, what the Fed was doing, and it felt like the world was falling apart. So it was from that time that I developed a very strong interest in macro and in basically the financial system. So, if you start at a law firm, it's really hard to move from there to go and work in the financial markets, especially right after the GFC. At that time, the economy was not doing very well. There were just legions of laid off bankers and traders just roaming about. So it was really hard for me to be able to get into that space. So what I ended up actually doing was I went back to school and I did a master's degree in financial economics. And afterwards, I worked as a credit analyst for a few years before eventually finding a job at the Fed, where I was on the trading desk, as you mentioned. And so it was kind of a roundabout way, but I was really happy to end up at the Fed because the Fed is basically one of the centers of the financial world. If you think back to what happened during 2020 COVID times or during the GFC, the Fed was front and center of all of that. It's basically the money printer. So when everything falls apart, it's the Fed that comes in and tries to put things together. And if you're on the desk, you get to see things that other people don't get to see. You get to see the inner workings. You get to hear what people are thinking inside the Fed. You could get to talk to large investors and get to hear what they're thinking. So it's a phenomenal way to understand just how the financial system works.
Yeah, that is really cool to hear. Based on that information, were you allowed to actually like trade stocks or anything while you were on the desk?
Well, we all know that Fed people trade stocks, right?
And Congress.
Oh yes, of course. So yeah, you can. So there are things that there are some restrictions. Funny, one of the major restrictions is that you can't sell treasuries. You can't short treasuries.
No, that would have been the worst trade you could have made.
Yeah, actually. So maybe it was for our own good. So you can't sell treasuries and you can't buy banks. The reason is just because there's a conflict of interest. The Fed regulates banks. So you just can't, it'd be weird if the regulator was also a shareholder. And just some other just minor restrictions, and there's a holding period limits, of course. But yeah, you could buy financial assets.
So, Joseph, there are two questions I had for that. One of them was I just kind of wanted to walk through a follow-up to what we mentioned or what we're speaking about back in Houston.
Yeah.
And I'm just curious to know if I've got my logic right, because like you, one of the things that I find is not frustrating, but challenging is when you try to explain these effectively very boring, but still very important concepts to people. Is just like, they know you're speaking English, but like the part of the brain that puts the words together, not there. So anyways, Nate, if you put up slide number 1 for me right here. So I've got 3 like little quick slides to show you real quick. And I think back to 2008, and where I'm going in this regard is I have a sneaking suspicion that really the Fed wants to be able to create spendable units of currency.
Yeah.
Just hypothetical example right here. And I'm fundamentally a real estate guy myself, and I note that pretty much all the business that we've done, both personally and then when we started getting more complex, has really been with Fannie or Freddie, or essentially, entities that issue mortgage-backed securities or the gate line conduits for it. And so the question I have is that if a commercial bank, and if they learned this in 2008, makes a loan against questionable assets, such as, like a mortgage-backed security that might not have been as good as otherwise, believed to be, at least at that time. Does this create a moral hazard if the implication is that the Federal Reserve will always step in to clean up the mess, will always step in to do an asset swap? So if you go to number 2, Nathan, this is kind of what I mean by that. So I think this is what happened, and assuming I'm right on this regard, is that the Fed would conjure up bank reserves and ultimately send the bank reserves over in step number 2 to the commercial bank. And in return for sending over the bank reserves, it would take on the bank's toxic assets as an asset onto its own balance sheet, if I understand, I think, the accounting correctly. But the net effect of this is that what the Fed's really done is that by buying these toxic assets from the bank, that the bank has already issued currency against in step number 1. Go to number 3, Nathan. What's really happened is that the bank reserves issued by the Fed are supporting real currency that's been issued into the real economy. Now, granted, there's this temporal dimension in here, but big picture, if you look at the transaction, these 2 transactions over time, is my understanding correct on that?
So, yes, that's so you guys got this right. So, just one caveat. So, when the Fed was buying, let's say, the toxic assets, didn't actually let go directly on their balance sheet. They would create like an SPV. I think it's called. I think back then it was called the maiden lane transactions. Okay, this is actually what the Fed does when they actually buy things that maybe don't look as good to the public. So, for example, recently they bought, last year, was it last year? No, 2 years ago now, they bought corporate bonds, right? So they didn't buy them directly. What they do is that they establish a special purpose vehicle, like a separate corporation, and then they lend money to that corporation, and then that corporation then goes and buys stuff. So it's not directly on the Fed's balance sheet, but it's the special purpose vehicle that owns the assets, and that was what happened during the GFC as well. So, okay. That's just a quibble. That the overarching idea is right. So the Fed basically indirectly had to buy some things that that were not good credit quality. I think back just to that overview. So initially, though, so this is kind of the problem of banking, right? So sometimes loans go bad. So it wasn't so much the intention of the bank to just kind of purchase a toxic asset or maybe make a really bad loan, but sometimes bad things happen. And what you thought was really good ended up being not very good. So you end up with questionable collateral. And so when you have this problem here, and this is a common problem that we see throughout the world, we saw it in Japan as well, back during their boom and bust, is that you have a banking sector who made a whole bunch of bad loans. What do? If you do like the Fed does, and kind of just go take those bad assets off the balance sheet, then just as you say, you have a moral hazard question. The bank can just go and kind of do whatever, create all this money, earn a fat interest income when times are good, and when times are bad, Fed, please save me, right? So
back holders.
The back holders, and a lot of people felt that was kind of what happened, and in a sense, it kind of was. But it was a hard choice. Now, let's say you let the banking system go under. Well, I mean, you have money in your bank, right? How would you feel if you got a haircut on that money? Let's say there's deposit insurance, but let's say you had $1 million sitting in a bank. Then maybe you won't have $1 million anymore. Maybe you have 800,000. That has a big impact as well.
Yeah, and just case in point, Cyprus, Greece, and Iceland.
Yeah. So that's actually the policy in the Eurozone now. It's not what we do in the States. It's called a bail-in. And so when the bank fails, hey guys, you thought your deposits were safe. Well, actually, you are lending money to the bank, and you should have done your due diligence better. So you got to share in the pain. That's because the Eurozone doesn't. The structure is different. You don't have like the fiscal authorities are not united, and they don't have a limited central bank like the Fed. It's more regionalized, and so they can't just go and fire up the printer and just save the banks.
Just a quick follow up to that point. So what I hear you saying is that the ECB, while it can issue debt, it doesn't have the regulatory firepower, the regulatory gravitas that the Fed would have over our banking system.
So I think it's a hard question for them because, again, you have the ECB with the European level regulations and so forth, but ultimately, let's say the banks are, but you don't. So here, the Fed and the central government are the same thing, and there you have national sovereigns, right? And the national sovereigns also govern their banking system. So I think there's not as much policy leeway to do these things. Remember back during the European sovereign debt crisis, you had people in Germany very much opposed to going to help, let's say, Greece, for example. And they're like, you guys should behave irresponsibly, so you have to suffer the consequences of that. So I think because it's a little bit more fragmented, you can't have the same political will as you have here to go and save the banks.
So
Maybe they're foreign banks. It's not. Well, those are the bad guys. Those in Greece, in Portugal. Maybe we don't want to help them as much. But here, that's less of an issue. If you wanted to go save J.P. Morgan or Citibank, you wouldn't so much be saying that's a northeastern bank. Why would you say that?
So basically, like a German-appointed regulator of the ECB would answer to German voters, not necessarily pan-European Union voters.
The funny thing about the European Union is that they're not really democratically elected, so so they don't really have that kind of responsibility. So I'm not precisely sure of how the responsibilities are separated, but they're not as unified and as streamlined as they are here, because they are ultimately, not one country. There's a European Union, there's European level supervision through the ECB, and that's something that was relatively new during the past few years. They're building European level capital markets, but they don't have a unified system the way that we do, and their politics isn't as unified in the same way. You have to deal with different stakeholders who have different views, and there's just not that much as much a cohesion as there is here. Hard to believe. Yeah.
You're talking about these banks going bust, but with the system that we have now, what will it actually take for a bank to go bust? Because there's nothing really preventing a bank from just issuing unlimited IOUs, except the accounting principles of other banks accepting their IOUs under their balance sheet. So what do you actually think it would take for a bank to go bust in this type of scenario? And how could we kind of reverse course to where there is an asset that prevents these banks from just creating unlimited loans?
So if you imagine there's just one bank in the world, you could think that maybe it doesn't have any constraints, but it does, because the deposits that it creates have to be redeemable for currency, right? So that's a limit. Do you have enough currency in your vaults? And where do you get currency? You have to get it from the Fed. So you can convert your reserve balances at the Fed into currency. So let's say you're a normal bank. Let's say you have some reserves and a lot of loans and a whole bunch of deposits, right? You obviously can't meet the redemption of all those deposits for currency. So that's a liquidity constraint.
Hypothetically, they ban cash. Then we're in a different situation where there's nothing that the bank can't create themselves to pass on to the actual to give them. This goes back to Justin's original question. So moral hazard. How do we deal with this? So the policy choice back then was, we're going to basically save the banking system. There's that moral hazard. What if they just go back and start causing trouble again? Then we'll be in the same situation where you have a whole bunch of rich bankers and everyone else gets screwed, right? So the solution to this wasn't to let the banking system blow up. The solution is what's called prudential regulation. And that's what Basel III is all about. So the solution was to make it so that the banks would not be in a situation where we had to bail them out. In a sense, you could think about it as ending too big to fail. So Basel III was basically the groundbreaking regulation that came out of this, and it severely, severely constrained banks. So in the pre-GFC, in the good old times, you had banks were kind of doing whatever, making tons of money. It's much, much less the case today, simply because of all these regulations. Now, I'll talk about a few, I think, that would probably be directly applicable to the constraints that you're asking about, Josh. So one, of course, is the leverage ratio. It's the intent and SL. Well, there's two of them, but SLR is the more binding one. There's the regular FDIC regulation, which people always had, but now there's SLR. The special thing about SLR, though, is it gets more binding the bigger you get. So FDIC leverage ratio, let's say 4%. But for SLR, the percentage goes higher the bigger you are. So it wants to punish a bank for getting too big. The purpose of this, of course, is to end too big to fail.
So that's the SLR. And there's a number of ways of getting to that. It's not just SLR, it's the GSIP surcharge that really ramps things up. And so that's what they do to make sure the bank doesn't just expand infinitely.
Isn't this all still just accounting principle stuff? Like if you don't account for this on your balance sheet, then technically you would be completely solvent in these SLR ratios, but there's still nothing that the consumer can do to call your bluff.
And that is exactly what happened back pre-GFC. They had all these derivatives that were off balance sheet. So basically they looked like they were okay, but they had enormous amounts of net derivative exposure that was off balance sheet. And the regulators saw that. And in SLR, so in calculating that, they actually take account of off balance sheet thing. That was the innovation between the former FDIC leverage ratio and the new SLR. So instead of saying total assets, it's total exposure. So you would have to account for your off-balance sheet stuff. So that's another innovation they have.
But if I can ask just a quick follow-up question to that. So I have very little insight into the regulation, but rather just a deep suspicion of those who write the regulations, particularly if it's the bankers themselves through the BIS promulgating their own regulation. But I think back to LTCM in '98 when it blew up. And as I understand it, the argument they made is like, listen, we're not net long or net short anything because we've just done an arbitrage play between, let's say, two different bond spreads that should converge as we get closer to the maturity of it. So rather than say this should count against our margin or we're extended on our balance sheet, like, no. There's a fancy term of art, and forgive me, I can't remember what it's called, but it's basically where you collapse the opposing, the supposedly equal liabilities of each other. Yeah. I guess then what I'm really trying to ask is that, do you see the bank's regulations written by bankers to constrain bankers as actually being effective, as actually having teeth?
I think it does make a difference. So of course it's not perfect, but it's a huge improvement than what was before the GFC, which is very little regulation. And it's not just that, though. So if you're just looking at the derivative space, another innovation post GFC was central clearing. So when you're centrally cleared, then everyone faces a centralized counterparty that manages risk. So you have less default risk. So if you think back to the GFC, there wasn't so much central clearing, so you took more counterparty risk. If you had a derivatives trade with a bank, well, if the bank failed, well, then you become just a creditor, right? Mm-hmm. But if your derivative is centrally cleared, then your counterparty is the clearinghouse, and the clearinghouse is regulated, and of course the Fed would bail that out, so it's a lot safer as well.
Yeah, that's actually that was my other question I wanted to ask, because we spoke about this back in Houston, and it's the mechanics of, well, just to go back. I think I asked words to the effect of, Joseph, do you ever see or if fate and circumstance conspire so that the DTCC, the OCC, the NSCC, the FICC, or whatever XCC were to default or were to face a settlement crisis where they would exceed the reserves, they would exceed their insurance policies, whatever. If you put up number 4, I think is the one where I put that there. Do you see the Fed as stepping in to basically guarantee or to do whatever they need to do to ensure that the whatever clearing corporation has sufficient liquidity to settle trades?
So listen, so these clearinghouses, they're called DFMUs, designated financial market utilities. So mm-hmm. they're like the power company. They're too big to fail. It is impossible that the government would allow them to fail. If there was ever any problem, 100%, you can assume there's a bailout. I think that's beyond question. So that, there's really no reason to allow them to fail. And they're regulated now, so of course there's more of a oversight and more of a stake in their success.
Yeah. Can I ask a follow-up to that? Yeah. The mechanism that the Fed would use, because I really understand it, to actually bail them out is they would basically create bank reserves, and then the offsetting asset for the liabilities of the bank, or from the Fed's perspective, the liabilities of the fresh bank reserves they create would be some sort of asset receivable from the entity they're bailing out, an IOU or whatever. These bank reserves would then go on to a commercial bank's balance sheet as a as an asset to offset whatever the clearing company's checkbook money was for the bank's liability. And
so
then
small detail that you wouldn't have known unless you were there. The DFMUs actually have Fed accounts. So
oh, really?
yes,
Actually, they put up number 5, please, because like I said, I did. Yeah, so I missed that part because I assumed that there was a commercial bank as an intermediary right here. So, okay,
So
they have Fed accounts. That's so you wouldn't know that unless I guess you work there. But because I have, you I had access to everyone's Fed account, so you just kind of know who has a Fed account and who doesn't. So they do. So
fair enough.
So there's the only counterparty. There's the Fed.
I mean,
there's not a bank involved with the DTCC.
No, and it doesn't have to be. But listen, if you're a clearinghouse and you're failing, you owe someone money. So as soon as that money goes into your Fed account, you probably have to go somewhere else, right? It has to be sent out to a bank. So the big picture is that you're right. Yeah, it will go into a commercial bank. The really important stuff, is you give a Fed account. So just roughly speaking, so you have the banks, Treasury, the foreign repo pool, which is the foreign central banks. So international organizations like the IMF have indirect access to the Fed, and quasi-governmental organizations like Fannie Mae, Freddie Mac, DFMUs. Yeah. So.
Was that with the back when COVID first started kicking off? I want to say when they were talking about those swap lines. The Fed was extending swap. That's the modus operandi that they're using behind the scenes, right? To basically give a foreign central bank access to the Fed, right?
So that's if they wanted to lend to the foreign central bank. If you're just a foreign central bank and you wanted a checking account, you can have one at the Fed. Same thing. Fed has a checking account at the BOJ and ECB as well. It's a central banking community thing. Fed has basically all the central banks in the world have a checking account at the Fed. They don't get their own reserve account. What they do is they get to basically have a banking relationship with the Fed, and it gets put into the foreign repo pool. So they do it's basically a reserve account, but it's not like they don't control it directly. Do you know what I mean? So how about this? It's like a narrow bank. So all the money, all the money that's deposited with the Fed is going to be backed by a reserve. So there are no loans. Yeah.
Because I'm just trying to think, because I assume that the ECB would issue bank reserves, but it's really an ECB bank reserve versus like a Fed bank reserve versus a BOJ.
They're different. But the Fed would have an account at the ECB. Well, actually, not so. It would be at a national central bank. So maybe like the Banque de France or like the Bundesbank, something like that.
Okay.
So with all this knowledge that you have, what do you think the biggest risk that you're looking at to the financial system is? Because we could all speculate and say if there's a repo spike in that last 10 days that would completely collapse the market, but what's something that you think is plausible that could actually cause a complete crash of the system?
It's going to be the debt market, the sovereign debt market. So I think we have so we have a habit of always looking towards what happened recently. We're fighting the last war. Everyone does it. Regulators do it all the time. So that's why they keep talking about standing repo facility, because we had a repo spike last time, right? So fight the last war. Oh, the big banks are scary and terrible. So that's what happened during the GFC. Now they're more like socialized utilities. They don't really have the same cachet as they used to. Now it's all the big tech companies that wield the power. So I think the big thing that going forward is really just the sovereign debt market, the treasury market. So that, we just really can't continue to issue $1 trillion of treasuries every year. That's just not sustainable. The market can't absorb all that without the Fed's help. So you either have QE forever, or you're going to have some kind of extremely strong dislocation in the market. So I'm thinking that is probably going to be the big source of instability.
What side would you take on that?
How likely, or what?
Do you think which way do you think that's going to play out with the Fed stepping in and ramping up QE or the?
Yeah, so no, I think it's going to be both. So once you have a big spike in rates, the policy response is going to come back. When we had a big spike in repo rates, Fed came in and they just kind of flooded the system and it went away. They'll do the same thing this time. So if you have a big spike in treasury rates, it'll be massive QE, and maybe that will be the end game, because then you kind of have to admit that you can never leave the market. And that's what happened in Japan as well.
And it's been happening in Japan.
Yeah, so. Yeah, no. And like the ECB, they've never even tried QT. It's not possible for them. So this is kind of how things will go.
I'll ask you one more question then.
Okay.
Let's say if you're JP Morgan or a massive bank and you have if you're going to make an actual purchase in the economy
Yeah.
to a different bank. Would you use your like owner's equity or dollar liabilities, or would you actually use the reserves for that?
So if you're
like,
JP Morgan and you're going to buy another bank.
Yeah, or let's just say you're going to buy a building.
Okay. Yeah. No, you would just. So you're going to be buying it from someone who's not a bank, right? Someone who's not a bank can't hold reserves. So you're going to be buying it by creating dollar liabilities, by creating deposits.
So you're going to create the money to buy from someone else.
Yeah. When a bank does something, that's what they do. They just so if I was a bank and I bought something from you, let's say something for $1,000, I would just go into your checking account and I would type in $1,000. Poof, that's how I pay you. Of course, my problem is being able to manage the liquidity of that. So in case you take that payment and you, let's say, send it to someone who banks with another bank, I have to have enough reserves to settle that payment with.
That goes back to if we keep on having more centralized and bigger banks, then what if they just all agree that we'll take the dollar liabilities onto our balance sheet without the offset asset?
Well, what would you buy then? I mean, liabilities are, yeah.
You can buy something, but let's say if we're both banks and we transact, we will agree that we'll accept each other's dollar liabilities without the asset offsetting it.
Basically, the banks would agree that they would never settle up at the end of the day with each other.
Oh, okay. Well, that's a lot of trust. I don't know. Well, what if this other bank screws me, right? So actually, I'll tell you something. So it used to be a very, very big market where banks would lend each other money. They lend each other reserves is what they would do. And then there was Lehman. And people who lent money to Lehman lost it all. So you had these banks that were lent Lehman, Fannie Mae, Freddie Mac lent Lehman, say $1 billion, all gone. From that day since, never lend to another bank in unsecured fashion. So you burned once, then you get scared. So
I'm good friends with a big hedge fund guy who's pretty old, and back in even the 80s and 90s, his bosses just told him if there's ever a liquidity crisis, just never deal with Lehman. They were just saying, we won't accept them. And so what if everybody just agreed? Maybe a bank just has a perfect balance sheet, but all other banks agreed we don't want their dollars. Could they still theoretically go bust?
How would they settle payments if they don't want their dollars then? I mean,
if they just don't want their dollar liabilities onto their balance sheet.
Okay, so basically all the banks promised to not do business with this. Let's say Lehman. No, everyone promised to not do business with Lehman. Then, Lehman is probably going to go bust, because if you are a client of Lehman and you wanted to send some money to another bank, then they wouldn't be able to do it, right? So it seems like that would not work. But so this is how the official sector fixes this. When you settle between banks, it's always with Fed liabilities, right? So the settlement is instant and final. So you don't have to worry about counterparty risk. Once the money is sent, it moves from one Fed account to another, and it's yours.
Yeah. And I think, Josh, maybe to your original question, it's not so much about the money creation, rather the money spending. Once the money's created, how does one actually spend it? Because that's when the back-end transaction is going to have to occur, where whatever the corresponding asset is to offset the liability from the bank's perspective when you spend your $1,000 or buy your building or whatever.
What economist or say books have really had the biggest impact on your life, would you say?
So like you guys, I'm getting the sense you guys like the plumbing of the system. I really recommend the work of Zoltan Pozsar. He's a strategist at Credit Suisse. He's probably
Snyder hates him.
Huh? Really? He's basically the giant in the money market space. So if you read him, you can understand a lot of what's happening in the money markets. So to be clear, not everything he says is correct. But if you read his publication series, it's called Global Money Notes, and you can find them on the internet. Just Google Zoltan Pozsar Global Money Notes. And it's a really good overview of a lot of things of what happens. So in the textbooks, you get kind of a textbook feel, but when you read the strategists, which is what Zoltan is, you get a more a market sense view as to how it is in practice in real life, and I think that's really helpful. Certainly many people in the Fed read him as well, and so he has a lot of influence.
Yeah. What about coolest person that you've met in the Fed?
Coolest person in the Fed. Oh, I'm not sure if the Fed is where cool people go.
I consider you a pretty cool guy, Joseph.
Thank you, thank you. The Fed is an interesting place, I guess. I mean, it's yeah. No,
No one.
no. Listen, I think the Fed is an uneven place. I'll say that. You have people who are very smart, but you also have people who are just kind of sit around every day. It's fundamentally the Fed is it's a business that can't fail, and it's run by people who can't get fired. So, yeah, it's a hit or miss over there.
Yeah, that's kind of how government agencies are.
Yes, exactly.
So, Joseph, thank you very much. Where can we find you? I know if anybody under the financial system, your blog is an absolute must read. I know right when I see one, I pass it right off to Gammon, and we call you up to get you on the Rebel Capitalist show.
Thank you.
Where else can we find you?
Yeah, so I have a blog. It's called fedguy.com. It's where I talk about some of the more current developments that are happening in the monetary system. I think the audience might be a bit more professional oriented because it assumes that level of knowledge. But if you're interested, I have this book where I write about more of the fundamentals of how the monetary system works. So, I mean, check both of them out.
Yes, and Fed Guy on Twitter as well. So he's
FedGuy12 at Twitter, at FedGuy12.
Thank you very much, Joseph.
Thanks, guys.